I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Good afternoon, everyone. This is your Editor-in-Chief, John Darsie, here to bring you the daily recap. So, today, the win streak for the Dow finally ended. 10 days is what it ended up as. RIP to the win streak. Scott tweeted towards the close, and I somewhat agree with him that, you know, it sort of feels good to have this out of the way for the market to get, stop obsessing about this win streak, and for the media to stop obsessing about this win streak. You know, it is impressive to see the Dow up 10 days in a row, but, you know, we had a few times where the Dow rallied really late in the day to end with those losses. So, you know, it wasn't the type of streak. The last time we saw a 10-day win streak was in 1996, and you had, a lot of huge up days during that period, and it was definitely a lot different market environment back then. But, you know, it's healthy to see these 10 up days, but, you know, now that we have that out of the way, we can actually hopefully get a little bit of corrective action, maybe some rest a little bit to give us some more calculated entries and shake things up a little bit from a trading perspective. But from a trading perspective, the big focus today was Apple, which, you know, last night we had that Samsung event that launched the new Galaxy S4 phone, and there's been a lot of tension on that as a potential Apple killer, an iPhone killer. But, you know, while the phone was nice, it was a little bit bigger. It had some new bells and whistles that were, you know, a little bit gimmicky, but kind of cool. But I think the presentation was very hokey, and it wasn't really as exciting and blockbuster as maybe people thought it was going to be. And so, as we talked about yesterday, Scott and I talked about it on Twitter. We talked about it in Off the Charts. We talked about it in the virtual trading floor. Is that event turned out to be a buy the news opportunity. And when you get the herd really expecting something to happen in one direction, and have everyone sort of hating on Apple, that's when you can potentially get a bounce. And today, we got to move back above that key downtrend level. But first, we'll go and take a look at that Dow chart that I talked about. If we go to the chart, we had those 10 up days in a row, stair-stepping higher here. None of these days were terribly impressive. We didn't have those huge momentum days like I talked about that we had in the late 90s. It's obviously a much different market right now, but right here we get that first red candle, and we can say goodbye to that win streak. We'll also take a look at the S&P rather than the spiders, because the spider chart is a little bit misleading if you don't know what you're looking at, because we went ex-dividend today on the spiders, and if you don't know what that is, Google it. But the S&P, you also see we traded slightly lower, very similar candle to the Dow. Nothing to be concerned about. Obviously, still yesterday's gains still held up. We're still very close to all-time highs in the S&P, and everything is still looking very healthy. But on a quad witching day, it's not surprising to see the S&P and the Dow have a little pullback, and it's healthy to see a little bit of corrective action because, as I talked about this morning, somebody who doesn't know anything about trading might say, wow, the Dow's up 10 days in a row. Traders must be out there making a killing. But actually, you go on the trading floor, there's a lot of frustration because people aren't getting that volatility that they really need to navigate in and out of stocks the way traders like to do. So we're going to go ahead to the Apple chart now. And as I talked about this morning, and as we talked about yesterday, it was a buy the news opportunity in Samsung, like I mentioned earlier. And we had this sort of accelerated downtrend, a more recent downtrend that started after we tested support into the earnings gap. And that's the one that got broken today, broke through about the 439, 440 level. And we had some nice follow through in Apple into the close in the last few minutes of the session, which sort of made it even more impressive of a day for Apple and an even prettier candlestick. But I really do think this could be the beginning of a bigger bounce for Apple. We had the Samsung thing out of the way. We have more talk about China Mobile and Apple potentially getting involved with them and expanding into Chinese markets, while U.S. markets for the iPhone are a little bit saturated, but China remains the big opportunity for Apple, and especially that type of news I would keep an eye on, in addition to any news about potential dividend or share buyback. The pressure is growing on Tim Cook and the Apple board to do something like that. They're not often the type of people to succumb to that type of pressure, but I think over time they might see the benefits of a potential buyback or something like that. Apple today, we'll take a look at the 5-minute chart just to give you a look at how it closed there. So, we saw in the morning, saw that gap up. Here's the after hours action. We trickled higher, had a little bit of a pullback intraday. It sort of looked like, and people started to think maybe it'll be pegged around that 440 level, but then, in the last hour or so of trading, we got a rally up to near the highs of the day. So that's very healthy action in Apple. And then we go and take a look at the banks. This morning, as I talked about, we had the Fed reviewed the capital plans of all the major banks and gave their determination. And most of the banks passed, but you had Goldman Sachs and JP Morgan, which are two of the biggest and have been the strongest stocks in the banking sector. They actually did not pass their capital plans. The Fed did not approve them. So those stocks saw some pre-market weakness. If you take a look at the chart of Goldman Sachs this morning, you can see the gap down here. And I talked this morning about the gap down is not that important. You really want to see how Goldman acts during today's session to see how important this news really is. And they're really just going to have to revise their capital plan and come out with a new proposal. So it's not a terribly big deal for Goldman Sachs. And today's price action sort of confirmed that. And ended the day higher, and it looks like it could be on this road back to highs again. I would yawn at this news, and Goldman Sachs will be able to correct their capital plan soon. JP Morgan was a little bit weaker because you have some more stuff about the testimony about the London whale situation in addition to the capital plan thing that we talked about. The London whale thing, most of that's out of the way, but you still have some of it being dragged back into the media and stuff like that. So JP Morgan might be due for a little bit of rest. And you might be best served to focus on a different name in the group. We're going to take a look at Wells Fargo, which is it's the more risk-averse bank among the sector. The company in general has a reputation and a history of taking less risk than a lot of these other banks took, especially prior to the financial crisis. And you didn't see, especially as this European debt crisis stuff was in focus over the last few years, you haven't seen as deep a correction in Wells Fargo as you saw in some of the other big banks. And then you see, it also didn't blast off and bounce as hard as some of the banks, but it has a healthy dividend yield, a nice tight pattern here that it's breaking out of. I think this is if you're looking to hold a bank longer term and really feel comfortable about it, I think Wells Fargo should be the one that you turn to. Like I said, they're more risk averse. It's a slower mover, a nice healthy dividend. Is one I would feel confident about, even if we do go through some turmoil again with, we're not going to get another financial crisis, I don't think, like the last one, but if the European debt crisis and things like that, if those things do come back to the fore, I think Wells Fargo will hold up better than the others, and as a long-term play, I think it's very attractive. We'll also take a look at Bank of America, which also gapped up this morning after it passed the Fed's test on the capital plans, and it sort of filled that gap a little bit early on. We're on the weekly here. We'll go take a look at the daily. It had a little bit of weakness off the open after that gap up, but then it rallied in the afternoon to close a little bit of a doji candlestick up there, but I think that's a very healthy candle to see it hold that gap and really hold up above those pivot highs. So I think Bank of America is the one that Scott's really been pounding the table on, and I think you could see Bank of America continue to rally this year. It's one from Scott's 2013 predictions as well. We'll take a look. We also talked this morning about a few tech stocks that were sort of losing some steam that were evidence to us that maybe that Dow win streak could come to an end based on some leadership sort of weakening in the market. First one we talked about was LinkedIn. You had Goldman Sachs upgraded the stock after it was up about 50% since its earnings report. The Goldman top tick, whatever you want to say about that. I'm not going to get into it, but we saw weakness yesterday. The stock still closed higher after gapping up big on that upgrade. But today it continued to the downside, and it looks like it's going to be testing that 8-day moving average there. So I would definitely look at that as your first level of short-term support to watch. And then if if it breaks that, I would look down to that 21-day moving average area, which coincides with this sort of little mini pivot breakout that LinkedIn had. But this is just evidence that some money is cooling off in this market, and you have some money rotating out of leaders, and you could see rotation into other sectors, or you could see a little bit of corrective action in the market. We'll also take a look at Netflix. It's a similar situation. Netflix yesterday sort of gave up Wednesday's intraday gains. It still held that gap, but this morning I talked about watch that gap, see if it holds, see if the 8-day holds. We entered that gap, and it looks to me like we're going to test that 21-day moving average. We'll wait and see on that. But I think if we do test that 21-day, that'll be a level that a lot of people are watching to see what type of correction we do get on Netflix after just a huge move since its earnings. It's trading at $100. It almost doubled over the course of a little over a month after that report. And I think Netflix could definitely be due for some corrective action, even below the 21-day moving average. And people might potentially be looking to short it if it does break through this little upper level support that stands around 176. About 175.50 to 176. So I'll definitely watch that level next week. If you're the type of guy who likes to short those strong stocks and look for the juicier short trade on extended stocks, it's one you might want to take a look at. We'll also take a look at Google, which has continued to slowly weaken after making all-time highs this year. It's been a stock that Scott has been pounding the table on. It was his 2012 macro stock pick of the year. You see this recent action. This is healthy corrective action for stocks and healthy rest and consolidation. Nothing to be too concerned about or concerned about at all from a macro level, but in the short term, you're seeing some momentum come out of these tech leaders. The 21-day moving average is another level to watch as it coincides with this previous breakout level, so makes it a natural level to watch for technical traders. We'll just flip through a few more charts of tech leaders that are weakening. You have Amazon. Amazon coming down. It's broken its 21 and 8-day moving averages. It looks to be testing this little floor of support here. I would definitely watch that as another potential tech short if you're looking to trade a juicier trade that's near its upper levels but could correct back down towards some longer term moving average. You see the 200-day moving average right there coincides right here with this level of support. I think if the market does correct, you could see Amazon weaken potentially down to that level. YHOO is another one weakening a bit after a big run to start the year. Coming back into its 21-day moving average. We're starting to see that 21-day moving average become a more significant level in some of these stocks that are pulling back slightly from upper levels. So I would keep an eye on those. And the last thing we'll take a look at is the oil service sector. We talked about rotation perhaps out of tech leaders and into some other sectors that maybe are a little bit more laggards. And that's what you're seeing with the OIH and some stocks in the oil service ETF. Today you got follow-through action in a down day for the market, which is constructive for the OIH, and then SLB is the one we talked about as a little bit more of a constructive pattern out of a little bit of a wedge there. And today it had a nice healthy candlestick. It looks like it could test those pivot highs up there at some point over the next few weeks. I think the big takeaway today is that the Dow's win streak is over. We can get that monkey off our back and stop worrying about that. It's sort of like a baseball player who has a long hit streak and everyone starts to obsess over that and they forget about worrying about whether the team's winning or not. And a lot of times it's a relief for that player when that hit streak does end or a team ends a long win streak and can just focus on playing again and focus on the process. And maybe we'll get back to that a little bit with the market, and traders will be able to have a little bit more success as the action loosens up. Apple, big news for the NASDAQ. If Apple can get some sustained strength, it could be huge for that index that has lagged the market this year and over the past 6 months or so while Apple's been in correction. And then you see some rotation, like we talked about the OIH, some money rotating out of tech leaders. I think you could continue to see sector rotation that'll be healthy for the market if it's going to continue on its path to 1,700 like Scott talks about. He's talked about by 2015. But at this rate, it looks like we could hit 17 a little bit earlier than that. But that'll do it for today's daily recap. We'll see you next week in the virtual trade.